Everyone talks about ETFs and index funds, but only one will actually make you richer. Which one? Let's find out. When it comes to building wealth through investing, two of the most popular options are index funds and exchange-traded funds, commonly known as ETFs. Both offer investors a way to diversify portfolios, minimize risk, and potentially achieve long-term financial growth. But which one is truly better for your journey to riches? To answer that, it's important to understand how each works, what sets them apart, and how their unique features align with your investment goals. Let's start with the basics. Index funds are a type of mutual fund designed to mimic the performance of a specific market index, like the S&P 500. When you buy shares in an index fund, you're essentially buying a tiny piece of each company within that index, all bundled together. This approach provides instant diversification and reduces the risk that comes from betting on a single stock. Index funds are managed passively, meaning the fund manager simply tries to replicate the index rather than actively picking stocks, which keeps costs low, a key advantage for long-term investors. ETFs, or exchange-traded funds, function in a similar way. They also typically track an index, offering broad diversification and low management fees. The main difference lies in how they are bought and sold. ETFs trade on the stock exchanges just like individual company shares. This means you can buy and sell ETFs throughout the trading day at market prices, giving you flexibility and control over the timing of your trades. Index funds, on the other hand, are priced just once a day after the market closes. Now, let's examine the factors that can influence your long-term wealth: costs, convenience, tax efficiency, and adaptability. One of the most significant factors in investing is cost. Both index funds and ETFs are known for their low expense ratios compared to actively managed funds. However, ETFs often have a slight edge, with some of the lowest fees in the industry. Still, investors should watch out for trading commissions, which can add up if you buy and sell ETFs frequently, especially on platforms that charge per trade. Many brokerages now offer commission-free ETF trades, but it's wise to double-check before you start. Another consideration is minimum investment requirements. Some index funds require a minimum investment, often ranging from several hundred to several $1,000s, while ETFs can be purchased one share at a time, sometimes for less than 100. This flexibility makes ETFs especially appealing to new investors or those with limited funds. Tax efficiency is another area where ETFs tend to shine. Thanks to a unique mechanism called in-kind redemption, ETF investors are less likely to face capital gains taxes when other investors sell their shares. Index funds, by contrast, may distribute capital gains to all shareholders when the fund manager has to sell securities to meet redemption requests. Over decades, the difference in tax impact can add up, giving ETFs a noticeable advantage for taxable accounts. However, index funds aren't without their merits. For those who value simplicity and a hands-off approach, index funds are easy to set up for automatic investing, such as contributing a fixed amount from each paycheck. Many retirement plans, like 401ks, use index funds as their primary investment vehicles. At the end of the day, both index funds and ETFs are excellent tools for growing your wealth. The decision between the two often comes down to your personal preferences and investing style. If you want more control, lower minimums, and greater tax efficiency, ETFs may be your best bet. If you prefer simplicity, automatic investing, and aren't concerned about intraday trading, index funds are a solid choice. The most important thing is to start investing early, focus on low fees, and stay committed for the long term. Whichever you choose, the path to wealth is paved with patience, discipline, and the power of compounding returns.